Welcome to Money Masters. Today with me is Anish Tawakley. He is the Co-CIO equity at ICICI Prudential Asset Management Company. And he has a varied background, in terms of what all he has done so far. And it is all an input, it's all a progression, which looks very interesting. So let me start with, the straight get on to questions and really understand his journey. And then we will get on to, this is a long conversation. So to begin with, welcome Anish.
Thanks, Dhirendra. It's a pleasure being here.
Thank you. Your varied experience, McKinsey, Bernstein, Barclays, Credit Suisse, and now ICICI Prudential, and then here to research and now managing money and Co-CIO equity. How things have progressed and how much of it was planned and random?
So that's always a difficult one, but let me explain how it worked out, right? Basically at IIM Bangalore, which is where I did my post-graduation, I basically fell in love with economics.
Okay.
And consulting was a natural progression because consulting, particularly strategy consulting, is about actually applying economic principles to business strategy. And I think that there's a common perception that a lot of strategy is hot air, but if you really get down to the basics, it's actually founded in underlying basis is microeconomics. I used to love that. I used to love the analytical aspects of consulting, not so much the client service aspects. So over time, I realized a better place for me to apply the same sort of thinking would be in the markets. And the way I see it, right, in consulting, you are helping businesses develop their strategy, plan their execution, whereas in market, it's the other side of the coin, right? You're choosing between companies based on, judging whether their strategy is right, whether they'll be able to execute or not.
A peep into the
future, right? But it's really two sides of the same coin. So even my fund management is very research oriented. I like to understand, form a good independent view of what I think will happen to this industry, what I think will happen to this company over time. And a lot of it is focused around, forecasting the earnings rather than discussing what the right multiple should be. I mean, there's no point discussing a multiple if you don't have a good grip on the earnings.
Yeah. But tell me, this particular background, has it helped, particularly the strategy bit, has it really helped you in avoiding a company about which people are so excited about, or getting excited about a company which everybody is very downbeat, about? Because those inflection points and your ability to look into, or having that foresight of imminent death or imminent boom for something which because those are the inflection point. And has it been helpful?
Yeah. So yes, it has. I mean, that's the short answer. And I think a lot of investing is about stepping away from the recency bias, the noise that is being created, the hype that is being created for either by extrapolating short-term growth or extrapolating near-term problems forever. Right?
Yeah.
And if you have that basis in economics, and if you've studied history, actually, a lot of it is also about having a passion for studying history of industries, studying the history of economies, saying, look, neither do great times last forever, nor do bad times last forever. And in a lot of cases, particularly when you're doing value investing, right, you might not be able to figure out what the solution is, but somebody will be.
Somebody will be.
And you have to kind of place your faith in mean reversion, saying, look, economics are such that it will revert to the mean.
So, getting to your core beliefs that, you have mentioned that long-term rationality of market. And how has this evolved? What really reinforced this thinking and how it got cemented? And, the short-term irrationality. Give me some example, broader one without, I'm not very keen on any specific company name but generally in terms of, an interesting example of such a thing.
So let me first break that up into what we really mean, right? See, basically returns come from two sources. Either you get earnings growth or you get multiples, right?
Okay.
Now, multiples tend to be high when growth is good. If a company is doing well, obviously you'll give it a good multiple, right? So what do I mean by saying markets will eventually be rational? Eventually earnings growth will be the reality of what the economics of the business supports, right? So, and eventually the multiples will be based on how the company is doing on earnings, right? So when I say markets can be irrational, it's like saying, look, if the company has had 6 great months, which you don't think will last, the multiple might expand. Now, there's no point discussing how long this multiple expansion will remain or not, right? The point is you get a grip on earnings and the multiple will look after itself, right? If you've got the earnings.
Yeah, it will be taken care of. So
it will take care of itself. So that's what I mean by when I say, look, in the short term, there can be irrationality. But what I mean by is that focus on the earnings, right? Focus on the earnings power of the company. And that is applied across the board. So for example, if you look at my published portfolios, I've been very underweight FMCG for a fairly long period of time. And this, captures both my sort of fascination with history and economics. What did the market get wrong in this period, right? The market was extrapolating permanently increasing margins, right?
Okay.
Saying the companies will keep on premiumizing and the margins will keep improving. But there is no industry in the world where margins go to 100. And then if you see the history of these companies, you also find that, look, something similar had happened in the early 2000s period. Margins had gone up a lot, but then corrected. And what was the sign that they would correct?
And that is the nature of capitalism,
Yeah, exactly. But what you see happening is that volume growth slows down. Because what has happened is you've underinvested in the business. You're over-earning the way I see it. And then ultimately, as you're saying, it's the nature of business, right? Some competitors will come in, start offering a better value proposition.
The emergence of Imami or emergence of, Patanjali.
So, whatever, right? So, and that's exactly, that's the kind of thing that happens. So that's what I mean by saying, look, you focus on saying, is this trend can it continue forever? Right? How is profitability faring? What is the normal profitability, even for a good company in that sector? And if you don't reach the same conclusion as the market is extrapolating, then you step away from it.
So that was about your early evolution or the genesis. Your approach. Can you explain how you apply the barbell strategy? First, explain the barbell strategy for me to understand. I just have to really absorb and comprehend this.
Right.
Sounds very fanciful. The barbell strategy across the funds you manage, and what kind of companies fit into your approach?
So, what do we mean by the barbell strategy, right? So, I would either buy companies that are cheap on valuations. And people have given up on these companies. They're completely out of favor.
Okay.
Or I would pay up for a company which is delivering which is a high quality growth company. So what does that leave out? It leaves out the stuff in the middle that generally goes by the name of GARP, growth at a reasonable price. So I leave that out, right? And my view,
you avoid that. Okay.
You avoid that, right?
Okay.
So let me explain the thinking behind that. Basically, I feel there's factor of safety at both ends, right? At the value end, you're really playing for mean reversion. People have given up hope. You're bringing patience to the table, right? People don't want to wait for 1 quarter, 3 quarters. People can't figure out when this problem will be solved. You just take the view, look, I don't know when it will be solved, but it will be solved. So you bring patience to the table, you sit and wait. The only risk you avoid is that it should not go bankrupt while you're waiting. So you don't play leverage in this. So you avoid... if you're buying value stock, right?
So getting into that particular segment with little care.
Yeah, but...
Or with that not being a write-off.
Exactly.
Eliminating the likelihood of write-off.
Without being a write-off, right?
Okay.
So here your factor of safety comes from the fact that you bought cheap, right? So I'm saying there is factor of safety at both ends, right? So here your factor of safety comes from the fact that you've bought so cheap. Now, if you're buying a company that meets both growth and quality parameters, I'm not saying you completely ignore the multiples, but what I'm saying is it doesn't really matter whether you're paying 40 times earnings or 45 times earnings, right? Because if the company is going to grow, say, mid-teens, the difference between 40 and 45 is 6 or 9 months of earnings. You won't lose your shirt, right? So then the point is not to say whether 40 is the right multiple or 45 is the right. But you need to be sure that the company you're buying is a good, high quality growth company. What is the test? It should be a market leader. It should be amongst the market leaders. It should have a demonstrated track record of profitability, and it should have compounding potential.
Scalable business. So
exactly. Either you should be able to identify that there
either
are some
a margin or a scalable business. So
either the market should grow or there should be some market share donors.
Okay.
Right. So there's some weak incumbent who's going to donate.
Will die there.
Yeah,
okay.
Who will die. Right. For whatever reasons. Right. Here the factor of safety comes from compounding. You need to be really confident that this company is going to compound at close to the rate that you want it to compound. Right. And then if I feel, look, then the risk is bounded. Right? Why do I avoid GARP? Because I find very often these are companies which have some similarities with the market leader, but are not as strong. Right? But the point is, number
it's not
7
going to make
company,
hell of a difference.
The number 7 company is not going to display. If the number 1 company or the number 3 company is doing the right things, the number 7 company is not going to be able to displace it. That happens very seldom. So I don't want to pay up for hope that a number 7 or number 10 player will suddenly displace the number 1 player.
Cover the ground and so you are on the two extremes and avoid the middle.
Avoid the middle, yeah.
Okay. So basically you are at active management.
Yes, absolutely. Absolutely.
Avoiding big mistake. You emphasize avoiding big mistake, our conversation with you earlier. And can you share a critical decision or situation where avoiding a mistake significantly impacted fund performance or, something which...
So typically big mistakes are made when you don't...
Winning by a vote, not doing something.
Yeah. So the underlying belief is this, right? That, and particularly in the large cap space, I'll have to modify that a little bit for small caps, but particularly in the large cap space, if you get a 75-100 basis point negative alpha in 1 or 2 stocks, right, it's very difficult to make that up. So that's the reality.
No, sorry, come back again, please.
When you do your, say what contributed alpha, what contributed negative alpha, if you get a negative 75, negative 100 from 1 or 2 stocks, it's very difficult to make that up.
Okay.
Why is that very difficult to make it up? Because in large cap, you're not going to get very many multi-baggers.
Big alpha anyway.
You're not going to get very big multi-baggers, right? So it's not like some company will outperform by 1,000 basis points the market. So you have to place a lot of care on avoiding the negative alpha. And what I find is the difference between if you say NSE 100 is 100 stocks, right? The 10th and the 15th is not what will kill you. But having the 85th company will hurt, right? So that's why I mean by a lot of focus on avoiding the big mistakes. Where do the biggest mistakes happen? Where you don't understand the balance sheet.
Okay.
Right? See what happens is the bulls are focusing on growth.
Earnings.
The bears understand that this balance sheet is hiding a lot of problems.
Okay.
Inventory is too high. Receivables may have a write-off. So I spend a lot of my time, and I've avoided a lot of companies without naming them that have dropped out of the Nifty 50 or Nifty 100 by just focusing on the balance sheet
But can't that be fairly quantitative way to looking at it? Because now the disclosure are quite stringent, and particularly for large companies.
I feel it should be.
But
not enough attention is paid to the balance sheet. That's the reality. That's the reality.
Yeah, market is dominated by the earnings, hounds here, so to say.
And sometimes not even the earnings, they stop at the EBITDA level the adjusted EBITDA level. So
yeah, I remember, the Buffett's, Buffett and Munger saying that, the moment he hears EBITDA, he says it's bullshit earnings.
That's one of my favorite quotes. I'm glad you brought it up. Yeah.
So now getting to, something which is very specific interest to all the, fund analysts at Value Research, which is you're managing the specific funds which you, manage yourselves. ICICI Prudential Bluechip Fund. How do you maintain leadership in the large cap space with intense competition? What has been your biggest learning in this fund? Because, I gave up on the large cap. I think the most, because at Value Research, we look at large cap funds purely as, when I look at the universe, not your fund, I have normally given up because most funds are unable to consistently beat the benchmark, or if not consistently, somewhat, even on a 3-year basis, they should. And majority of the funds don't. On an aggregate basis, the category does not. So they have lost the plot. I even, say that, and sometimes the alpha that you derive is not worth your pain, For the inconsistency, if you are not getting rewarded for something meaningful, what's the point? So how have you done it?
So my job
how
is
do you
waste
do
of
it?
time.
Okay.
No, but actually, when I started fund management 6-7 years back, I started with Bluechip and manufacturing.
Okay.
And honestly, some of the guys said, look, this is a total waste of time job because large cap is going to go the index fund route and manufacturing has no hope in India, right? So, no, but...
and that is largely true.
But on a more serious note, see, 2 or 3 things. One point I would like to emphasize, particularly because you evaluate funds, right? It's actually unfair to compare an actively managed fund only with the index and say passive is better. Because the right comparison is an active managed fund with a passive fund. Okay. Which also doesn't beat the index, right? So passive fund also underperforms the index because
adjusted for expense. Yeah,
because the expenses are a reality. So the fair comparison is active fund with passive fund because the passive fund is also not beating the index, right? Now my approach is basically that, this is a lot of people read Howard Marks' memos. His first memo was the one I found very interesting. He says if you're consistently second quartile, you don't have to be first quartile in any given year. You end up over a 4 or 5 year period in the first quartile.
Okay.
Right? And that is where it ties in. I really found it very, something I could relate to because it ties in with my sort of investment philosophy of putting risk first. Right? Eliminate the bad apples, then you are left with the good apples, and then your chances of doing well over time are better. Right? And then you have to be patient. Right.
So an apple a day makes it,
yes,
keeps you healthy. Okay. And then tell me about ICICI Prudential Business Cycle Fund. What is your approach of spotting cyclical shifts? And can you give me an example here too?
So this fund is about 3.5 years or 4 years old now. And as the name suggests, our fundamental belief at iPru is that all economies, whether they are growing over time, over long periods of time, whether they're going fast or slow, will always have cycles. What's a cycle? You have a boom, you have slumps and booms. In a slump, what's the problem? Not enough demand. So factories are lying idle, people are finding it difficult to get jobs. So demand at the overall economy level is falling short of capacity. And in a boom, there is not enough supply, right? So people are adding capex, you're having trouble retaining your employees and stuff like that. And some of these things, they're often misinterpreted. So 3 years back, it was very common to hear that India has surplus power. And I used to find that a very odd notion. Power should be the limiting factor to our output. Anybody who's saying we are surplus power, what you're actually saying is there's not enough demand. So what do you need for an economy that's suffering from weak demand is demand generating fiscal and monetary policies. So the key point I'm making is the first step in this is you identify whether you're in a slump or in a boom. So if somebody is telling me that India has surplus power, it tells me we're in a deep slump. So you identify which point in the economy you are, and then you say, okay, what is the right fiscal, monetary or exchange rate policy that will help you in this? Which will. So the moment, fiscal policy turned supportive, the RBI became more tolerant of inflation, at least in the short term, being around the 5 handle, rather than trying to bring it down immediately to 4. We realized that, look, the policy stance has changed enough that the economy will start to recover. And what gave us more confidence was that the real estate activity picked up. Because real estate is really fundamental to both, creating jobs. And
also, there are a lot of other variables. RERA was in the pipeline and it was becoming a reality. And
so now, when do we say? So that was, we identified the slump. We figured out that, look, the policies are right to alleviate it and actually, frankly, the slump lasted longer than it should have. these actions could have been taken even earlier. Now, when will we peak? The flip side of what I'm saying is when you run out of power capacity or when you run out of cement capacity, that's when this cycle will peak. Right? At that point, you will say, look, broadly, economic output is as high as it can be at this point in time. And then you'd say, look, margins are at the peaks. Now, don't extrapolate further margin improvement, build more conservative earnings forecast.
So,
And then you move to a different set of sectors. It's really my favorite fund, actually.
Okay. Any example of, the timing a shift, a very well-timed shift on this inflection point? On the
so I would say, unfortunately, the fund is only 4 years old.
Okay.
But we were, but the point is that even when we entered, I would say we got it right in saying, look, we were very early in diagnosing that the shift is happening, right? So we went into domestic cyclicals when nobody was going into domestic cyclicals.
Spotting the inflection point in this sector, in this fund is very critical. Yeah. Okay. Now this ICICI Prudential Manufacturing Fund, with a focus on manufacturing, which has come on the forefront. Of course, 10 years back. In fact, ICICI Prudential had something called a service sector fund,
Export and service.
Export and service sector fund. And, if somebody would have talked about this 10 years back, people would have laughed at it and moved on, so.
Yeah, actually they did. I mean, it was a very hard sell.
Okay.
To the distributors when we launched it in 2018. 2018 when we launched it was a very hard sell because basically people said manufacturing has no hope in India.
Which industry excites you? Where will be the, because now your ambit is much broader. There are older manufacturing companies which manufacture things. There are newer sectors which are still not in the public domain. When I listen to all the stories around what is actually in the headline, the semiconductor capacity and this and that, they are not going to be in the public domain in recent future. So where do you go?
So
what is the
I'll give
highlight?
You my view on manufacturing in India.
Okay.
To be honest, the contra view here is that I don't think manufacturing in India has done badly. Right? I think manufacturing has done quite well. And let me explain why I say that. Right? Manufacturing always follows real estate. Or let me step back actually. You can have two types of manufacturing. Right? Either you can have manufacturing to meet export demand, or you can have manufacturing to meet domestic demand. There's no third reason for manufacturing to exist, right? Now, on the exports front, right, my view is India will remain a goods importer. You have goods and services, India will remain a goods importer, and let me explain why. We want to attract foreign capital, so we want to run a surplus on the capital account, right? So we'll have an inflow of capital. The flip side, and this is mathematical, this is not my point of view, it's mathematical. If you have an inflow on the capital account, you will have a deficit on the current account. You can build some reserves, but we have enough reserves now, and reserves have a cost, so you won't build reserves infinitely. So, simple point is if you have an inflow on the capital account, you will have an outflow on the current account, which means you will have a current account deficit. If you have a current account deficit, you'll be importing some stuff, you'll be exporting some stuff. Because we are so good at services exports, we will always be a net exporter of services.
Okay.
Right?
Yeah.
So if you're a net importer and you're a net exporter of services, there's no...
Things get balanced.
You will be a net importer of goods. So the fact that we are an importer of goods is, I say it's a feature, not a bug of the Indian economy. It's a feature in the sense that we are an attractive destination.
It's a fallout of the complexion.
Fallout of the complexion. Exactly. Right? And I also say, look, so manufacturing activity from the exports front has done what it was required to do to keep our current account in good shape. Current account has not been a problem because manufacturing has balanced. We've exported as much as was required to. So I'm not a big fan of export-driven manufacturing. This thing. Now, when will domestically driven manufacturing grow? And there I say it's all driven by real estate. If people have larger houses, they will have more room to keep goods.
Okay.
Right? The amount of, you have a nice large room here, so we have all this set up. We have a nice table. If you had a small room, you'd have a smaller table.
No,
you wouldn't have a fan.
I would like to have a bare room because that having space is the style.
Yeah, that's also true. Well, the more the space you have.
No, but I get the point here.
Right? If there are 5 people living in a small single room, there's only so many clothes.
You can't have it in Bombay.
They will not have 3 pairs of shoes each, right? Then there won't be any room. So my simple point is that manufacturing depends on real estate. Domestic demand for manufactured goods depends on real estate. And it's the exceptions that prove that rule, right? We're very good at pharmaceuticals.
Okay.
We're good at auto because these two things don't depend on the size of your house. You'll consume the same amount of medicines whether you live in a big house or a small house. Car you park outside the house, you fight for parking space, but you buy the car anyway. Or you'd buy it. So my focus on the manufacturing fund is domestically driven manufacturing,
Thesis, okay.
which still, which has a follow-on effect if the housing demand works well. I'm less super excited about export-driven.
Everything else that is actually happening or emerging.
I mean, those will not become a very large part of my portfolio.
Yeah, they might be critical, but it may not be. In the context of this manufacturing thing, you're saying that, the surplus, the deficit that we have, current account deficit, and there is a talk, there are symptoms that, we just might be a surplus country. How does it really change your thesis here?
There is no reason why we should be a surplus country. Because if we are a surplus country, it means we are investing.
Our deficits have actually come down quite dramatically.
Yeah, but first let's understand what the deficit and surplus means, right? A surplus country is one that is supplying capital to the rest of the world, which means you're investing
elsewhere.
Then you're saying, look, on an overall aggregate net basis, there are better investment opportunities outside the country than there are inside the country. That I don't think is true.
Okay,
that's the logic, right? Now, people give the example of China, that China ran a current account surplus. But yeah, what was the consequence of that? They ran a surplus, which means they bought a lot of US G-Secs, government securities. When they bought them, the exchange rate to the yuan was 8.3. Today, the yuan has appreciated. So they've actually lost money in their investments overseas. Right? So water, like water flows downhill, capital should flow from richer countries to the less well-off countries, not from the less well-off countries to
the richer ones. Now getting on to the most interesting thing, and I have a very different question here as a follow-on to my basic question, that how do you identify small company opportunity that has potential to grow into larger market leaders?
So that is where, when I look at small cap and large cap, because I run both the small cap and the large cap fund, a lot of it is common. What is common? The definition of a good company does not change. A good company is one which has a strong competitive position in its industry. How do you know it has that? It should pass some tests. It should be a market leader. It should have a demonstrated track record of profitability, and it should be growing. Right? Now, if you are, for example, if you're in a large industry, like if you're in an auto industry, the market leader ends up being a large cap. If you're in a small industry like auto components, say tires, then the market leader ends up being a small cap.
Or a mid cap.
Or a mid cap, right? So you're not evaluating a large versus small cap in the first place, right? It's like saying, are you a market leader? A good company has to be a market leader in its industry. That doesn't change whether you're looking at small caps or
that is basically the scale of the business.
That's the scale of the industry you're operating. You are a market leader in your field. Value research is a market leader in its field. If you were to list, you would be a small cap, but you're as strong as a
micro cap. So if there is a definition of one,
oh come on, you'll be a small cap. No, but my point is, it's very difficult for anybody else to beat you. Right? So you're a strong company. Now the only thing you have to be conscious of is that in the small cap space, there may be some multi-baggers, right? And you have to be open to taking in some companies where you feel a lot of upside potential could be there if things go right. A little bit more risk than in the large cap space, right? So in small cap space, right, you have to be willing to take a little bit more risk for companies that really have that upside, right? That they could become multi-baggers. So you take a slightly bigger risk, but that doesn't mean you invest recklessly across the portfolio.
Your framework is tested, proven company and showing symptoms of being a leader. However small or narrow.
Exactly.
So you are not getting into something which is buying a story that, one day it will be, a wishful thinking, a hope.
See, I mean, I might buy something as an option value at 25 basis points.
Okay.
But sizing is actually a very important aspect of portfolio management, right?
Okay.
If you say, but I would still have scrutinized it a lot before I would have fallen.
Those ideas don't dominate your portfolio. Okay. Now getting on to a very interesting thing, which looks like, a fancy name, but how do you go about proving it otherwise? ICICI Prudential Innovation Fund. How do you approach innovation-led sectors in India and globally? What indicators do you track when deciding a companies to invest in? How do you spot one?
So actually, innovation fund is probably a slightly broader definition of innovation than is sometimes used. Right? What do we mean by innovation, right? It's not just coming with a dramatically new product, right? An innovation in how you reach the customer. An innovation in smaller innovations, say even in consumer products, right? Changing the pack size,
doing
changing
things better. Okay.
using a
Marketing,
different
sales, producing
also
it.
counts as innovation, right? So the way I think about it is it's actually our growth and quality fund. It's our quality fund. Typically, what you would find is that companies that are gaining market share are doing something innovative across most industries. I mean, leaving aside some very old world industries, right? Even if you look at consumer goods, automobiles, even in the IC engine space, right? The companies that are gaining market share will be doing some innovative activities. So this is a fund that basically looks at companies. Eventually, when you boil down to what is the test of innovation, eventually it becomes, is it a market share gainer? Does it have good profitability? Is it delivering something? And the people who are, so it's the opposite of a value fund, is the better way to put it. Right?
Okay.
Right. A value fund is companies that are.
And it should translate into financial parameter, which is, that's the evidence.
Absolutely.
So to say.
Above average, yeah.
So how do you go about spotting it? Is there any different framework in your team which actually creates a filter which
so it's
spotting one?
Basically, the research team is the same, right? We would look at companies, typically they would be in the more expensive. So in my barbell approach, they would be at the expensive space.
Extreme,
right?
Okay.
And then you say, look, is it because of some entrenched cost advantage? Then you eliminate it, right? Because it's just got a better mind than somebody else. So it will always be more profitable. Or is it because of some activities that the company is doing?
Doing things better.
Doing different things every year. And then it qualifies. But it's typically companies that have higher profitability gaining market share.
It primarily gets into qualitative supported by numbers.
Yes,
okay.
Absolutely.
So there has to be, discovering the process which is driving it in a way.
Yeah, but it's part of the normal research work. Yeah.
Now coming to, we are done with specifics on individual funds. Alpha generation strategy. Alpha cross funds. What is the, how do you approach this alpha bit?
So
all that you have said so far,
right, a lot of it will be taken care of. Right? It's basically saying, look, you avoid the negative alpha. A lot of it is avoiding negative alpha. In some cases, saying
any unique approach that.
No, I think more of it is fund specific. It's defined by the risk parameters also, right? So some funds are more conservative funds. Like Bluechip is a more conservative fund than Business Cycle. Right? So Business Cycle will have a higher risk budget. So when I say alpha, you have to have a corresponding risk budget. You cannot ask a fund manager for higher alpha with a lower risk budget, right? Because you will have to take bigger bets. So actually, across funds, the alpha, ambition is constrained
sizing
by and yeah, exactly. Right. Okay. So in Bluechip, I would take smaller bets.
With
the same relative preference than I would when I was managing Focus. Now Webber manages Focus, which has only 30 stocks.
30 stocks. Yeah.
It's not the same stock would be in Bluechip.
20 to 30, or revising.
The similar stocks would be in Bluechip and Focus, but the size of the bets
will be different. Now you as a fund house has tilted more towards value, and how do you go about balancing it?
So this is my favorite thing that I like to clarify. Actually, we're not a value house. And this impression has come about because Naren has been seen as a value manager. And actually, Naren is not a value manager. Naren is a contra manager.
Okay.
Naren is a contra manager. If you look at stocks that he buys after they've dropped a lot, he buys the most expensive stocks that would never fit into a value portfolio otherwise. But having said that, so the important point here is we do have an underlying basic belief that you have to be contra, right? But that doesn't mean you never buy expensive stocks.
Okay.
If an expensive stock has underperformed for a period of time, it's still expensive, but it's underperformed, it's contra.
Yeah.
So we see ourselves that our fundamental belief
contrarian investor, and
you have to be contra, but you can be growth, you can be value, you can be quality. Apart from, so you're not momentum. We're not momentum.
Okay.
Effectively is the way to think about it.
So you are not willing to get slotted into any of these things more strongly or dominantly, which you are not.
Yeah, I wouldn't say we are momentum. That we are, but different fund managers have the freedom to have different styles.
Now, risk management and market cycles. How do you manage risk across different funds? Because they all have. It's very complex. Such a wide variety.
It starts with the risk budget, right? So
it starts with the risk allocation.
So you basically say, look, what's the active weight we'll run? You can think of investing as saying, look, this is my return target, and I will see which one is going to give me highest return. The other way to do it is, this is my risk budget, and this is where I want to use it, right? So in blue chip, it's always run with a 40% active weight, approximately. Then I will not let it get to 50, I will not let it get to 30. So I will allocate that active weight where I see highest returns. If my risk budget was different, I would run it differently. So risk management is about active weights.
We've made, quite a few cyclical calls, big ones. So can you share one or two major calls that defined significant shift in your portfolio strategy? It changed the complexion altogether and you benefited, or you were very embarrassed about it?
We went very underweight banks.
Okay.
After the consolidation in the banking sector.
Public sector banks?
More recent consolidation in the banking sector. In the financial sector, let me put it this way. We went very underweight banks because we were able to realize that the competition for deposits would be extremely intense. And the banking community, the analyst community was not expecting the kind of strain in the banks. Similarly, the banking deposit growth is another cyclical variable. Ultimately, bank deposit growth is controlled by the RBI.
Yeah.
Right? Bank deposits are an outcome of monetary policy stance, right? And what happens is, in economic terms, right, it's called the velocity of money. How much money you need to keep the economy going. When people are feeling confident, when they're using all non-bank channels for financial intermediation, bank deposit growth will be slow. So cyclically, we were able to recognize that bank deposit growth will remain slow as long as equity markets are this buoyant.
Are booming, yeah.
Because the velocity of money is higher and the competition is very intense. So that was one
that you were able to anticipate and take a call on that. But really, it hasn't come to a grinding halt as such. There could be deceleration of the deposit growth, but there's a threshold scale which continues.
So the velocity of money is lower, but it's not. It's not. You still need bank deposits to transact.
That's the raw material anyway.
So the way to think about it is, you need bank deposits either for transactions or as an asset preference, right? To say, I want to park my savings here. I know I don't need to spend it. It's just buy where I'm buying. When the economy is strong, this asset demand for bank deposits comes down. But you still need bank deposits and cash to be able to transact. So to that extent, there is still transactional demand for bank deposits.
Okay. Now, collaborating in research, you've been a research person as well in this company. How do you share research insight and other fund managers? What is the framework? How is the knowledge sharing bit?
Two things. One is, we have tried very hard to ensure that mechanisms are in place that everybody is allowed to express their point of view.
Okay.
Right. And the thing I tell all junior research analysts is that, don't think like Anish has this view, or Naren has this view, or Rajat has this view. In your area, you should think you are the expert. You need to know more than anybody else in your area. I may know more about other areas, but you need to know more about in your area. And that's your critical. And once they have that confidence, they feel open. What we also have is a very, very good system where every analyst, from the junior most to the senior most, and every fund manager is allowed to express a buy or a sell view on a stock. And that's recorded. And while I might vehemently disagree with him, I will never object
to it.
To the putting a view. And that gives, sometimes they might feel overawed in
And it's
debating with
it's
a
not
senior
being
person.
argued as such.
Yeah, it's not being argued. He's put an alpha.
Okay.
So it shows the conviction, right? He's put a buy alpha, he's put a sell alpha. It gives a lot of, because that's recorded. And also if I force somebody...
And it is an input to his career progression?
Absolutely.
Okay.
So that's a very quantitative, transparent and recorded way of putting things down.
Has your McKinsey background really contributed to devising these processes? Or?
No, I mean, I wouldn't like to take credit for all of them. A lot of them were...
A lot of it was in place anyway. But it got refined.
Yeah, so what we've, like, I think one was McKinsey had a very non-hierarchical approach to problem solving. And this notion that even the junior most guy has the same...
Can have a say,
right? That I think we've, in the way the discussions are handled, right? I've tried to inculcate.
Now coming to, future of investing and personal growth, what are the key trends or sectors you're watching that could become game changers in the future of investing? We have seen the confluence of, UPI, digital, Jan Dhan account and everybody having a smartphone and, your ability to access a marketplace seamlessly.
So
what
I see
magic can
a lot
happen?
of these are enablers, and as long as incumbents keep up, they don't even have to be the first one to do it, right? If an incumbent bank adopts technology at a quick enough pace, maybe not the fastest, the incumbents survive. I mean, you can see the same banks
dominating or continuing. Yeah.
Still a lot of the same as auto companies. So, within industries, very rarely do you have things shift. Some new industries will come up.
Invention of
new industries will come up, but a lot of these are enablers. So I would stick with people who have done enough innovation to keep pace, is the way I see it.
Now my final question. Give me your big blunder or a mistake that has significantly influenced your approach to your investment decisions today.
This actually biggest one was not here at ICICI. It was actually in Bernstein, a company that we had invested in went bust. We earned 15% of the company.
Okay.
But to give credit to Bernstein, I was the analyst. I was not penalized. In fact, I was rewarded and made an example of that. Look, the guy's research was fine. The company went bust because the auditor had
messed up
on cash.
Okay.
On cash, not on inventories, not on receivables. Every other risk that we could have known.
Okay. It turned out to be a satyam.
Something like that, right?
Okay. So,
but the point is, what that taught us was that research cannot be penalized for risks they have highlighted. So I had highlighted all the risks. Then the fund managers chose to, and that was the great that was characteristic of a great investment house, right? If you can not penalize people with hindsight, penalize people if they get things wrong that they should have known
for the judgment So what was how it has influenced your approach? This is actually a disaster.
Yeah.
Looking at numbers and they are they are fictitious.
Yeah. See, it doesn't change it changes the way how you deal with things in the organization, right? I typically don't I have a lot of arguments with the team, but they are before things go wrong.
Yeah. Okay.
Right? A lot of debates, but I don't like to point fingers after something has gone wrong, right? Like it's happened now. What's the point? He or she will introspect and figure it out, right? So that's my organizational learning.
Managing it.
This will happen, right?
In a more productive and as a stepstone to learning. Yeah. Okay. So thank you very much, Anish, for being here, sharing this insightful and your whole evolutionary journey so far.
Thank you so much for having me. Big admirers of what you do. So
thank you.
Pleasure being here.